Last time we talked in depth about GDP itself. So this little segment, we're going to get into some details from the reading from the Handbook of Macroeconomics to discuss how GDP changes over time. And so basically to take as an organizing principle around this discussion, I'm going to focus on the charts from the reading, because as was generally the style of the author, they would introduce a major topic and then show some data that has concrete examples of the particular issue they were talking about. So, right, keeping in the theme or notion of using data to think critically about the world around us, that's going to be the theme of this part of the lecture. And so, first, we have GDP as a measure of economic output of commerce broadly, and we've been talking about that for a while. So, and naturally, we're interested in what makes it change. And so, one way to approach that question, what causes GDP to go up or to go down, is to maybe look at GDP historically and see what kind of patterns we can observe, just like we might if we were looking at house price changes, see which states were hit hardest and try to make some kind of reasonable conclusion based on that. So let's look at the history of GDP growth over time in different locations and see if it maybe gives us a clue a little bit about what causes GDP to change. So this is the first graph from the reading. And so we should talk a little bit about some features of this graph. So this is GDP per person, right? So this is the per person share of the economic output in the United States. And you'll notice over on the y-axis that this the scale is maybe not it's a little bit unusual, right? This is a log scale, so these are every unit we travel up on the scale, we are doubling the amount of economic output per person. So, and this is a pretty normal thing to do if we're thinking about for example, with an investment at a bank with compound interest, right? Of course, any amount of time you invest with a bank is going to look like a hockey stick, right? Because interest will earn interest on interest and so on, and so it will, take off very quickly. And if you're looking at 100, 200, 300-year time scales, it will zoom up very quick. But if we had some reasonable level of return on our bank account investment, if we looked at it in percentage terms, right, that if we did a log scale, as it's called, but the idea is to just make each unit and the y-axis on our bank balance graph represent a doubling of our money, we would see very clearly that we have a straight trend, that the percentage change in our dollar value of our bank account is linear, and the slope of that line would be the interest rate we're earning at the bank, right? So if we are getting a 2% interest rate on our deposit, if we plotted the graph of money in our bank account, it would follow a straight line in percentage terms because we were getting a 2% return. So we're looking at the same thing here. So in effect, right, the GDP of the United States functions kind of like a bank account that pays an interest rate of 2%. And you can see this is very consistent back to 1880. Right, that the United States has very consistently had a GDP growth rate of 2% per year. Right, there are some notable exceptions. Interestingly enough, through the late teens and mid 20s, right, so even into the roaring 20s, the stock market was going nuts, right? So fortunes were made and lost in the stock market But meanwhile, the regular economy was actually somewhat lagging. This is kind of consistent with what we know about the Roaring Twenties, that there was a lot of financial shenanigans going on, that there was capital being misallocated, and that ultimately all of that stock market hubris and then ultimate crash spilled over into the real economy, right? So there was nothing actually special about the 20s in terms of real output. There was just a lot of activity on Wall Street that then caused a very serious decline in actual GDP, right? So if we're looking at the history, we don't see much going on until the Depression, when we see a very drastic decline. But then, right, through the 30s and from the mid 30s to the mid 40s, we have unprecedented levels of growth. Never before or since, right, in the United States, really. And so, right, so how can this be? How can we have this complete disaster that then is, a total recovery? Well, at least to some degree, and we can see this when we look at this later, the factories that were humming along and producing in the 20s, just like they always were, didn't disappear, right? The actual physical capital, that the education people attained during the 20s didn't disappear. It just, there was a lot of misallocation going on because of the crazy chaos caused by the Depression, right? If so many people are unemployed, it doesn't matter if you're educated, then your education isn't being used, and that's effectively a misallocation of resources. That the economy wasn't functioning the way it should have been given the resources it had. But over time, that was figured out. And you can see, right, there doesn't appear to be a huge difference between the pre- and the post-war period, or at least during the war, right, that this was basically just a return to normalcy. And then after the war, we went right back to 2% just humming along. So, as crazy as the stock market gets, right, it moves up and down, and we have crashes, and the employment market moves all over. In the grand scheme, the interest rate, or the actual growth rate on capital and labor together in the United States is very steady at 2%, and so that's probably pretty surprising. This if we look here, this is broken down over a bunch of different periods, and you can see that right over 1870 to 2007 is 2%. If you take the up till the beginning of the Great Depression, it's slightly less. If you take the post, the including Great Depression, right, so the end of the Roaring Twenties up through today, it's ever so slightly higher, but really there's not much going on. It's fairly boring. I mean, if we do the 70s to the mid 90s, it was slightly lower, and then the 90s to the late 2000s, it's slightly higher. Right, and if we focus very specifically on the internet era, we see some significant growth. And if we focus specifically on the post-internet era, we see significantly less. But again, none of these are particularly large, and that's, I think, in stark contrast to what happens in the financial markets, right? That the real economy doesn't actually change all that quickly. It kind of just steadily grows with, the occasional hiccup. So that, or just scooting back real quick, right? This graph starts in 1880, because that's the, at least the data that's available from that we can get estimates for. So this is obviously a much coarser estimate, but this is now for the planet, right? So we're looking at the GDP of planet Earth and also its population. And you can see that for a long, long time, right, if we go back all the way to the early Christian era, that really not much happened in terms of total economic output of human populations, right? The people or population is going up, or we see that through 1200, 1400, 1600. The population is increasing, and GDP is still pretty flat. That the experience of someone living in 800 or 600 AD versus someone living 1400 or 1600 AD isn't really that different in terms of economic output. And if we think about those times, right, chances are you were farming. Chances are you had, of just a few articles of clothing, right? Maybe you had a family Bible in 1600 and you wouldn't have had one in 600, but these changes aren't very significant. And then, right, as we get into the early 1800s, you can see that there's an inflection point, and GDP per capita takes off. Where again, right, we know takes off is 2% per year, but that 2%, even 2%, was much, much higher than what had been achieved historically. So if we go, this is that actually broken down, and we see right in the starting, so in the area in the time around 1900, we are just a little bit above 1%, and eventually we settle into the 2. But right between the year 1 and the year 1000, we actually have a negative growth rate. Right, the population of the planet increases slightly. The GDP has declined. Right, so right, and this is partly probably the fall of the Roman Empire and other factors, but you end up with an economic reality that isn't particularly different. So we are kind of in our modern times used to this notion that the economy grows consistently and things are always improving or changing or getting better, and this was historically is a relatively recent event, that even in the early history of the United States, right in 1820, that's after the founding of the U.S., and we're still growing at 0.15%, and again in real, right, in GDP terms. Right, the financial markets behave differently, especially the equities market, because those are that's a concentrated security, right? The risk is concentrated in the hands of a few people who make very risky bets on the tail end of entrepreneurial endeavors, right? And that's not, right, in 1820, the typical economic experience is still somebody farming a plot of land they possibly cleared themselves or inherited with the trees taken off, and that the fact that stock markets exist and people invest in them is not really a huge portion of what's going on economically in the United States. Whereas later the growth rates accelerate, and now the financial markets are a much larger part of the total economic output of the United States. We can see also population is growing quickly as well, and that is tied directly in with the GDP growth. They feed each other, right? So we have this this sort of reality that's in the post 1800 world. We have these compounding growth rates that, while each year are small, overall make for drastic changes in GDP over time. And so a reasonable question to ask, right, is what drives these things? And so as economists have thought and studied these things and modeled how this might happen or might work, they've settled on, according to our reading, they've really settled on 4 major categories, and this comes out of just thinking about the logic of how this investment and subsequent return must be. So that we call the models of this type, which this is a growth model, but that fits the data well once you calibrate it to what we observe. And so this is a Cobb-Douglas model, it's called. The idea is that physical capital and human capital are basically an investment. It's like a stock of, they call it capital stock. And the idea is if I'm a farm and I plant more trees, that increases the capital stock, and that's naturally going to increase the economic output because I'll have more trees producing fruit. And that would be an increase in physical capital. if I have more workers move into town. Now my human capital is increased. I can pick more apples from trees, or I can juice them more easily, or whatever the case may be, and the result is more output, right? So investments in physical and human capital have, in effect, a kind of interest rate that drives the output, but that this engine of growth, which is investments in physical and human capital, can be modified or changed by misallocation and knowledge. So in a Cobb-Douglas specification, this ends up like a multiplication problem where you have, if my misallocation factor is 0.5, I get rid of half of my economic output because I'm just being silly in how I do things. Or maybe I have a lot of ideas, and that is really helpful, and so I end up getting a bonus because my knowledge is really good. And that, again, this sounds kind of just like, it sounds like a toy or something we're just playing around with imagining, but if you can actually go into the data and look at these different aspects or inputs into economic output and get growth estimates and get some quantitative answers for how much each of these matter. So we're going to look at them individually. So the first one we'll look at is physical capital. So that's what this chart is talking about. So up here, the title is important. Let me talk you through it. So it says the ratio of real K. So that's K is physical capital, right? So the ratio of real capital to real GDP. So if you think about it, right, if this is large, that means I have not a lot of capital or not a lot of GDP if it's large. Right? So if I have a bunch of factories that are sitting idle because I built them and I didn't actually need them, that would be physical capital that is not producing economic output, and so that would mean that K would be large and GDP would be small, and that would make that ratio big, right? So in a world where physical capital is not being put to use, that number would be big, and in the capital we're in the world where we're just going crazy, stretching our physical capital as far as it can go, then we would have a ton of output for not a lot of capital, and this number would be small. All right, so this is data back into the Depression, right? And you can kind of see the story we were talking about earlier. So through the Depression and into the World War II, we have a bunch of capital and not a lot of output, right? And this is maybe a signal of misallocation, that we have excess production capacity that's not being utilized to actually produce output, right? Maybe we have human capital, or we have people with education and skills that aren't being used in soup lines instead, right? That somehow over the course of the Depression things got misallocated, and so we've got a bunch of capital and not a lot of output, and so we get the spike in the Depression. But that's not actually the point of this graph. So what the point really the author is getting at, if you look in the post World War II, right? If you look post World War II, the ratio of physical capital to output is fairly constant. I mean, we could probably say there's a slight decline in non-residential capital, but it's very slight. I mean, really what we can say is that if we look at the actual physical capital, right, that the actual physical capital that's employed in getting stuff done, it produces economic output of roughly 1/3 to 1/4 of its size, right? So that's this ratio of capital to GDP. So if we're at 3.5 or 3, that means there's 3 times as much capital as GDP. Or that 1/3 of our capital investment is earned back in GDP output typically, and that this is a very constant number, right? Back to the mid 40s, this just is pretty flat. right? Especially for non-residential, private non-residential. So again, this is not government, right? Government housing is not in here, right? These are private companies doing non-residential investments. No real estate, no malls. Just if you have some kind of physical capital used in the economy that's not for people to live in, and it's owned by a private company, this is very flat. Right? So total GDP to that capital stock is basically constant. And so that's interesting. That's not necessarily what you'd expect. And it means that even though we're using different capital than we did in the 40s and 50s, that the amount of capital we're using is fairly constant. So, I am recording this on a laptop. Obviously that, laptops weren't a normal stock and trade for people back in the 50s, right? But they probably would have been, a person in my position would have been using a mimeograph and maybe a typewriter that, in terms of economic output and inflation-adjusted terms, is probably roughly the same, right? That our machines have gotten better, but the total investment in them is roughly the same. Partly because output has gotten more, right? So as output goes up, so the end result is we have more capital and we have more output, and it stays roughly the same. Can see this effect also just in terms of breaking down that physical capital between structures and equipment. So obviously, right, you can see World War II having a huge effect here, right, that equipment jumps from 5% to 15% of GDP as we're building P-51 Mustangs and artillery and all the stuff that we need and transport vessels, all the things we needed to contribute to the war effort. There's this huge spike in equipment and maybe a slight reduction in structure, but that quickly after the war ends, that levels off, and we have a fairly constant share of GDP spent or used as investment in equipment capital for producing economic output, right? So the equipment basically has this sort of constant 7-ish% share, and maybe a slight decline at the end. And that structures maybe have declined more since the 50s, maybe a drift from 20 to 15 or so. But again, that as a percentage of what we're doing, right? If you think about the economic output of the United States, we're spending a little more than 5% and then a little more than 10% on top of that, pretty consistently reinvesting in stuff we need to make our economy go, right? The physical capital that makes it happen. So even though we're in the information era, this actual physical stuff that makes the output occur, that proportion of our economic output is the same, right? Our reinvestment rate in this physical stuff has stayed fairly constant. It's interesting though because the prices have not. So this is the same period, right? So we have 1930s, so up to close to today, and this is now the price of equipment. And you can see that like many of us experience, the residential physical capital, right? So these are homes, right? Homes and apartments and stuff, condos, that these prices are going up. And on a log scale, right? So we're at log scale again. So we double every time we have the same space, that it's this linear increase. So you have a percentage increase in costs of residential, right? So for the same amount of residential, we're paying more, and that's increased over time. And it's even more striking for non-residential structures, right? So those have increased even more. So, and if you think, right, a lot of residential structures are in suburbs or in small towns, right? The non-residential structures tend to be in larger metropolitan areas where the price increases have been biggest, right? So ultimately, the share of the share of structures has been constant, but it's being spent on more expensive structures But again, output is higher, right? So you have higher output, higher input, and that's probably because prices on structures are increasing. Now, in contrast to that, equipment has very quickly declined. So the price on equipment has declined. So again, how do we end up spending the same amount on equipment, right? If I go here, equipment spending is flat when prices are declining. The answer is we are buying more equipment, right? So there is more items of equipment, more physical equipment being used today, but it's cheaper, and so the overall expenditure ends up flat. And if you think about, right, of comparing a factory in the 50s to a factory today, there's probably a ton more equipment in a factory today, right? You have robotic welders, and you have winches and a bunch of IT stuff going on to make everything run smoothly. So you have a whole bunch of stuff, but it all has come down in price a lot, and so it ends up balancing. So that's our, let's see, so those are, again, two major drivers for physical capital. And now, again, and these are inputs, right? So we think about inputs, we've had the structure as a share of our investment is fairly constant, equipment is fairly constant. The total capital as a percentage of GDP is fairly constant. But of course, right, what we actually are doing and what we're charging or getting paid for aren't necessarily the same thing, right? So we can think about, especially for labor, right, what the labor input into economic production is different than the wages, right? Now, presumably, if you have more input, right, if you're doing more, then you would get paid more, on average, all else equal, and so ultimately we can think, all right, well, of the production that we're making, there's some payments to be made, right? Like if we're building if we have physical capital, we're possibly renting it. If we have labor, we're paying wages, right? So we're paying out to get access to all of this capital. Who's getting the payments, right? So for the longest time, at least if you look back to the 50s, it's very consistent that roughly 2/3 of the payments go to labor and 1/3 goes to capital. And that, makes sense if you think about, right? Think about a Walmart. How much of the money in Walmart is going to pay for the cinder block and tin roof, especially since you can get a loan over 30 or whatever years for it, versus all the people that are in it, right? That there's probably a ton more money going into the labor running around Walmart than into the physical space. Now, that's not really a fair example because there are, of course, much more capital-intense industries. But just in general, looking over the course of recent history in the United States, we have labor getting 2/3 of the payments. But you'll see, right about the year 2000, this changes-ish, right? I mean, this isn't a really strong signal, but we see the capital share creeping up and labor share creeping down. And so that's of some concern. People wonder why suddenly is labor different, not able to command the share of the proceeds that they used to be able to, and of course there's lots of ways to speculate about why that would be. Nevertheless, it's an observed pattern, right? So this coincides, right, with effective wage stagnation in the U.S. Right? If you look at median wages over the last little while, they've been fairly flat, and so it's not that the U.S. is getting less productive. It isn't, right? Productivity has gone up, output has gone up, economic growth is happening. It's just that the gains are, for the moment, over the last 15 years or so, have been accruing to capital rather than to labor. But so that's just how it is, and we can wonder why or think about if it's worth fixing or what's going on, but it's nevertheless a fact. So that's the physical capital part. So this is going to lead us into human capital. So when we come back, we'll talk about how investment in people rather than investment in equipment and structure also feeds into economic growth.